Noah Blackstein is here. We're going to talk to him about the markets, the impact of rising bond yields. Of course, he is the senior portfolio manager at Dynamic Funds. Noah, what do you make of that uninversion? If it's different, if it's because of what the long end's doing versus the short end, what does that mean? Is this a precursor of a recession coming in 3 to 6 months? Kind of crazy to think when you're looking at such a strong GDP expectation for this week.
I agree with Mike. Usually when the curve is uninverting, the Fed is slashing short rates because there's a problem in the economy, and so the short end is dropping a lot faster. This has been much more the long end coming up to meet the short end, but there's very few instances of this happening in history, so it's hard to extrapolate what's going on. We've had so many abnormalities since the pandemic in terms of the bond market. You've had people on here calling for a recession within 6 months for the last 3 years. So we've had a lot of signals that are a little bit off. Thus far, the economy seems fine. There are certainly stresses in autos we heard about earlier today. There are some stresses in small business and housing because of where rates are. Credit has been thus far contained, though, spreads are starting to widen a little bit here. So, I think this is all in line with a Fed pause for sure.
But if rates are higher for longer, maybe that's the long end saying, okay, we get it, we believe, or is it a sign that, hey, the bond market, the buyers there are worried that there's a lot of other bad things coming and fewer buyers that are going to be around, and so they don't want to be the ones, you're going to have to pay them more in order to step in here.
There's a lot that's been, I don't know what higher for longer means. I'm not sure what the Fed is referring to. Are they saying nominal yields are going to remain high? It
means maybe they're not going to cut rates even if the economy turns down, so you're not going to look for a rescue.
Right, they don't control the long end, though. So, or are they going to target real yields? Because real yields right now have taken off to nearly 250 basis points since July.
Right.
So that's very tight. And I think that's why they're talking about financial conditions, and Powell seemed to say a lot of work has been done for the Fed more recently. So, they could still have positive real yields and be lowering rates next year and keeping the real rate the same. So I'm not sure what higher for longer is.
Well, if they're doing quantitative tightening and rolling off their balance sheet.
If they're doing quantitative tightening, rolling off the balance sheet, holding rates while inflation continues to fall, 3-month PCE is now down at 2%. That's still tightening. So I'm not 100% sure what higher for longer necessarily means or what they're referring to. In terms of the long end of the curve, you have term premium, you have supply, you have quantitative tightening, you have very popular steepening trades that have been in the bond market, you have whatever Japan is doing in monetary policy and longer term demand for U.S. Treasury. So there's a lot going at it in order to try and extrapolate. Thus far, though, there seems to be a lessening of the risk of a recession in the near term anyway, and that seems to be pricing into the bond market, which isn't bad. But we do have to watch spreads, especially on the credit side.
So what do you do with the stock market at this point? You think the stock market will bottom out here? Have we seen the worst of things? Is it up?
I think real yields has put a tremendous amount of pressure on the stock market since July. I think, though, especially if you look at it today, the NASDAQ 100 is up about 33 or 34%. I was looking at a mid-cap growth proxy, which is up 2% year to date. And the further you go down in market cap, you can see the pressure of yields. I think that's really where the opportunity is, especially if you're looking for longer-term areas of secular growth, which is sort of what we do. I think those stocks have been sideways for a while. The fundamentals are improving, and they haven't had the big move. They're as much beneficiaries of AI as any of the mega-cap tech stocks are. We'll get a lot of earnings this week, which are important. I think probably $8 trillion of market cap reports this week, so that'll be important. But I started in the beginning of the PC era and the networking era, the beginning of the internet, the second wave of the internet, and the beginning of the cloud. I've never seen anything like AI before in terms of return on investment, return on productivity. I've never seen the cost savings. I've never seen technology implemented so quickly that's yielded so much return and cost savings for corporations. PCs, we didn't know what was, with the cloud, we'll figure it out. This, whether it's reducing labor costs by 90% at call centers, whether it's searching unstructured data like emails and PDFs and using Gen AI to figure out how to save more cost. We heard Petrobras did that and saved $120 million in taxes. I've never seen anything like it. So this is real, and this is a secular area of opportunity. I think the bull market is every unit of output is going to require less labor.
But you're talking about it not as an AI power just necessarily for technology stocks. You're talking about stocks writ large. Any company that is taking and implementing that is going to have far better margins.
Correct. That's what I'm talking about. It's going to transform American business and corporations that are employing AI to reduce labor costs and to do things much more efficiently and more productively, for sure.
So where do you buy as a result of that? Are they AI stocks that you like, or you're just looking broadly and saying, okay, you just mentioned Petrobras, what else?
Well, I think that right now the focus on AI has been on compute, right? So we've been looking at NVIDIA, or we've been looking at the data centers and things like that. Compute matters and it's important, but the most important thing is data. None of this matters if your data is garbage, right? Garbage in, garbage out. So it's corporations taking their data and putting it into the cloud, not necessarily running large language models, but even small language models, and being able to then improve their business processes and discover cost savings.
Look, I'll tell you, AT&T talked about that last week with their earnings. They said that they have been able to reduce headcount when it comes to something like their call centers, first of all, customer service centers, but second of all, for when they dispatch people to go out and fix these lines too. So you would look company by company and say, I'm going to like this company a lot better because...
I think the companies that are enabling this, so they're moving toward the cloud. They're going to need new databases. It's a new stack of technology. They're going to need data lakes and data stores from companies like that, Databricks or Snowflake, which we own. Okay. New databases like MongoDB and stuff. Thus far, it's been on who's building the data centers, who's got the chips. The next wave is getting that data and learning from that data, and that's really the software side of this. And every American corporation will be transformed by AI. It's not just to the benefit of the big tech companies.
Noah, you look at things and you say this is a time to be like fully invested in the markets if you think this opportunity is coming?
You know, I'm a long-term investor. Equities have been whipped around by interest rates and macro like they never have been before. 60 to 70% of the moves in stocks are driven by rates right now. It's 70-year or 60-year high in terms of what's been going on with rates. So, you know, if you're in this for the next 6 months, you can get 5% in treasuries, you should. That's great. If you're in this for the next 5 to 10 years, then you sort of have to be in equities, and you should use weakness as your opportunity. But there's long-term drivers.
Is this weakness, though?
Is this weakness in the market?
Yeah, where we're looking right now.
Yeah, for sure, especially in the
down
areas...
Down 8.5%, 9% for the S&P?
Well, I think in the mid-cap space, which has been lagging for sure. You know, I look back in 1991 where you had that 30% NASDAQ correction around the Gulf War and stuff. You know, it wasn't the leaders of NCR and digital equipment and IBM that took off. That was the beginning of the first part of my career with the Microsofts and the Oracles and the EMCs that were there. This is that next transformation, certainly in technology, but it's going to have applications in retail, in healthcare, in industrials, in energy. It's just doing much more efficiently. This is a probably multi-decade, but certainly multi-year phenomenon.